Hi, this is Chapter 4 on fixed rate mortgage loans. In this chapter, we'll focus on fixed rate mortgages, do a little bit of history, and then also focus on when we have closing costs, or when we have points, when we have prepayment penalties, coming up with what is the return to the lender or the cost to the borrower. I also want to encourage you to look at the slides or the presentation on some of the problems that we'll do in the back of this chapter also. So what do we mean by pricing a loan? When we say pricing a loan, we want to figure out what would be the interest rate, the fees, and any other terms. The length, is it 15 years, 30 years, 40 years? What are the clauses? Are there prepayment penalties and so forth that lenders offer to borrowers? Okay, and specifically right now we're looking at just fixed rate mortgages. So within the fixed rate realm of mortgages, what would be the different interest rate, fees, lengths, clauses, and so forth. And these are all influenced by supply and demand, the interest rates that lenders are willing to accept and demand for housing. One of the things we're going to focus on is computing the yield again to the lender, which is the cost to the borrower. Okay, and because of these various provisions. Just a quick note on interest rates, the interest rate charged. The way we come up with the interest rate charged is we would get the nominal rate, which would be the real rate of interest. And that's remember, if we call back from managerial finance, the minimal rate of interest that must be earned by savers to induce them to divest funds from the present to future consumption. It's that rate that we'd say when there's no risk and no inflation. Okay? If we add inflation to the real rate, we'd come up with a nominal interest rate. Okay? Then if we add risk, this can be a variety of different risks involved in mortgages: default risk, interest rate risk, that interest rates go up, prepayment risk, liquidity, because if interest rates go down, then the bank, people prepay, and then the bank gets stuck having to reinvest the money at lower amounts. Liquidity and marketability risk, legislative, tax status, rent control, etc. Okay. We add that risk and we get the actual rate that's charged. Just a real short history on the development of mortgage payments. In the pre-1930s and 40s, it was very commonplace to have to put 50% down. They'd be interest-only loans and then due in 5 years. Okay, so if you think about that, if the average house right now, I'm thinking Massachusetts is around 300,000, maybe 350 even. Let's say 300,000. So you'd have to put 150,000 down to buy a house as someone, just starting out. You'd only pay interest, and then you'd owe the entire other 150 in 5 years. So as you can see, it made home ownership very tough. After that, we got a better economy in the U.S., and we had relatively real high growth and low inflation, and it brought about the idea of the self-amortizing loan. And again, amortizing is the process of loan repayment over time. So if we say that we're amortizing a loan, then we're saying that we're really looking for the goal to, most of the time, make that loan be zero. There are a couple of, we'll have a look at maybe a balloon payment once in a while where your goal is to get it down to a certain amount. But unless they use that term, when we say amortize, we'd say a 30-year amortizing loan, then the goal is you pay off that loan, so when you make that 360th payment, 30 years, 12 times a year, you don't owe anything. So every payment is a partial payment of your principal, paying that back, and the rest is interest. The first type of amortizing loan was the constant amortization loan, or the CAM. You don't really see this anymore, and we'll tell you why, so I'm going to go quickly over it. But basically here, the constant, so if you think about constant, you say, well, we want to be constantly paying back the principal. So if the loan was for $60,000 and the term is 360 months, 30 years, 360 months, you just take $60,000, divide it by the 360, you get, in this case, $166.67. Okay, so that's the amount you'd always pay to pay down the principal every month. And then on top of that, you would compute what the interest is on the loan balance at that time. Okay, So if you look in your book on page 75 and 76, and you'll see the exhibits there, and you probably should look at the book along with me here because I am going to be referring to many of the exhibits. But when you look at those, you'll see. So, for example, in the beginning, there's a $60,000 loan, 12% interest, so it's 1% monthly. It's 12% compounded monthly, so 1% a month. So the interest, when we first take out that loan, that very first month is $600. And then the constant amortization, $166.67, so the monthly payment at the end of the first month is $766.67. The ending balance then is the $60,000 minus this constant amount that we're paying to pay down the principal, the $166.67. Okay, and so that brings us to that the ending balance then is at the end of 1 month, $59,833.33. Okay, so that's the rate that you calculate the interest for the next month. You take that number times 1%, we end up with $598.33 is the interest. But every month we're going to pay the same amount of amortization, $166.67. So you can see the effect. If you look at the, I guess it's the fifth column over, it says 3 plus 4, the monthly payment, it starts at $766, and it goes down to $765 after 1 month, $763 after another month, and all the way through. So your last payment 360 months out, is only $168. Okay, so the problem here, if you look at the next page too, you'll see an illustration of paying off the balance. The problem here is we're going to start off very high. We're going to start off with a payment of $766. 30 years later, you're only paying $168. But what happens with those people is that your income generally goes up over time. So you'd rather have it in the opposite direction, in fact. So because of this aspect that many people couldn't qualify, because usually you qualify on making the first payment. So they would look at their income, they'd have to be a certain percentage of what the payment was, and they couldn't qualify for that top amount, or in this case, $766.67. So because of that, the next type of amortizing mortgage came along, which was called the constant payment mortgage. And these are the ones we're used to calculating. And we've been calculating on our calculators through managerial finance and even in Chapter 3. Here's when the payment is the same all the way through the life of the loan. Okay, so still the goal is to amortize. So have our, basically, as we did in our calculators, our future value is 0. But we want the payment to be the same. So we want it to be an annuity all the way through. Okay, so if we look at page 76, we really want to look at 79 to see the amortization schedule. If we look at page 79 on table 4-5, you'll see a typical fully amortizing loan, constant payment loan. So in the calculators, we would have put $60,000 as our present value, $360 for N, and then we would have put the interest rate as 1 because it's 12% compounded monthly, so we need to take that 12 and divide it by 1, and it's fully amortizing, so our future value is 0. And then we compute the payment, and we see that it's $617.17. Okay, and you'll see what happens here is the payment in this case stays the same, but the interest amount goes down. So the very first year, that interest is the same amount, $600. But since less of the loan is being paid down, you now have an amortization amount, an ending balance loan of $59,982. You figure out the interest payment on that, and you see that's $599.63. Okay, so what you'll find is the monthly payment's the same, but very early on, if you look at those first 5 or 6 years, out of that $617, $17, $18, $17, $16, $18 of it is just for amortization. The rest of it's all an interest payment. When you get down to the very end of this, down to the 360th month, out of that $617, at this point, $611.06 are to pay back the principal. Only $6.11 are the interest. Okay, so the key thing here with the difference between these, with the CAM, you had that you always the amount you were paying, the payment was decreasing, but you were paying the same amount of amortization all the way through. In the fully amortizing, the constant payment mortgage, the payment is the same, but the amount that you're amortizing is slowly going up and the interest rate is slowly going down. Just to look at another couple of comparisons of the constant payment mortgage. On page 80 in Exhibit 4.6, you'll notice that halfway through the CAM, the payment is $516. But again, obviously, with the constant payment mortgage, you're still at the $617. The other thing, the way to look at it, and the key thing here is looking at Exhibit 4.7. Again, one of the ways that you're going to qualify, we're jumping ahead and away because this is a couple of chapters out, but when you go to qualify for a mortgage, they base it on a certain percentage of your income. So the higher the payment, obviously that's the higher the percentage of your income. So if you needed 25% of your income for the payment, and that worked out to be $617, then obviously this constant payment mortgage would allow you to get that mortgage. But if it was a CAM loan, you wouldn't qualify because the most you would qualify for was a payment of $617, but a CAM starts out at $766. And that's what they're illustrating there with that BI and then bringing it down, as that means the buyer's required income. So they're trying to illustrate in that graph in Exhibit 4.7 that by going from a CAM to a constant payment mortgage, you can actually bring down the buyer's required beginning income. So more people could qualify and buy the houses. So that was one of the large benefits of the constant payment mortgage. Determining the loan balance. Again, I mentioned this in Chapter 3. We'll be doing this over and over and over again. So you can look at this example, especially on page 82. They show you a couple of ways to do it. As I mentioned earlier, we're going to stick with just the one way. We are going to just say, to figure out what the remaining loan balance is, we'd say, what are the remaining payments? Okay. We may have to at first figure out the payment if they just give you the terms of the loan. Once you have that, you'd say, what are the remaining payments? So, for example, if it was a 30-year loan, you had 360 payments, and you wanted to find the balance at the end of year 5, that would be after 60 payments. So now instead of using N as 360, you do the 360 minus the 60 you've already made, your N would be 300. Everything else would be the same interest rate, same payment, and you just calculate the present value. The same. The present value of all the rest of those payments would be the loan balance. And we will practice this when we do the problems in the back. Okay, now one thing we want to bring in now are closing costs. There's 3 categories of closing costs: statutory, third party, and additional. We need to go through these each. The first group is the statutory costs. Now these are the charges for legal requirements pertaining to title transfer, recording fees, and things like that. So these are fees that are required by state and local government's laws. So they are not income to the lender. They're paid to the government agencies. So even if you pay it all cash, you would have to pay these. So because of that, we do not include them as additional costs for financing charges. So yes, they're out there. We would have to pay them, but we don't include them when we are calculating what is the cost of financing the property, because they would exist either way. Then there's third-party costs. So these aren't going to government agencies, but they're also not going to the lender, or not usually. Legal fees, appraisals, surveys, inspections, and title insurance. Those are the big ones. So the bank would pay a lawyer, hire an appraiser, and so forth. So again, these are not going to the lender. So again, they'd usually be paid even if you bought them for cash, and they would not be considered part of the costs of borrowing. The last group is the loan closing costs. These are additional income to the lender. So these will affect the cost of borrowing. So big ones, loan origination fees. So a cost for processing the loan application, preparing loan documents, scheduling credit reports, things like that. And then you might have fees. You use higher interest rates or you use prepayment fees. And then a big one is discount fees or points. So let's look a little bit more into these. Points. Many of you have heard this term points. And you might say, what is the points? Well, point, first of all, is 1% of your loan. That 1 point of a $100,000 loan is $1,000 and so forth. So you say, well, okay, why is the bank charging points? Well, there's a few reasons. One might be because interest rates tend to be, as they say, sticky, moving up and down. So they don't exactly just move. They tend to take a little bit to move them. And it gives people a little bit of a choice on what to do. Because we'll say, well, you'd see, an interest rate of 6.5 and it doesn't have any points. And then you see an interest rate of 6.25, but it has 1 point. An interest rate of 6 and it has 2 points. So what you'd see is if someone's willing to pay some points, pay some upfront money, they can lock in a longer, for a longer time. We'll say time, they can lock in a lower rate. Okay. But we're going to see that these points need to be spread out over the length of the loan and then the key there is the length of the time that you have the loan. Okay. So if you pay off the loan quicker, it really generally is not a good idea to use the points. But if you tend to keep the loan for a long time, then it may be worth taking the points. And that's what we need to look at right here so that you can analyze when you go into a house. You say, I know this is just a starter house. I'm just beginning here. So I don't expect to be here very long. I'd rather take a little bit higher rate and not pay the points. If the next house you say, I'm going to be here for the rest of my life, then maybe you lock in the points, and it's a low rate, so you say, I'll pay the points to really lock in a low rate. You could also use points for compensate for risk. So you'd say for somebody else, well, yeah, I'll give you what the going rate is, but I got to charge you another point because this is a riskier loan. So let's look at an example. And this example is on page 85 and 86. $60,000 loan, 12% compounded monthly. It's fixed for 30 years, and we've already calculated this earlier on using, again, present value of $60,000, interest rate of just 12 divided by 12 months. 360 is our N, 0 is our future value, and we calculated the payment. $617.17. Now, if this came with 3 points, that would mean you'd have to pay 3% up front. So in effect, you are not borrowing $60,000, you're only borrowing $58,200 because 3% of the $60,000 is $1,800, and that would have to come off the top and be dispersed to the lender. So knowing that we really don't borrow $60,000, we're really ending up, once we pay the points, $58,200. We'd want to know, what was the effective cost, either cost to the borrower or to the lender, either way you look at it. So they're getting $58,200 is really the present value. Still the payment we calculated originally, $671.17, still for 360 is your N. And now we're computing the interest rate. Okay, and again, when we get that interest rate, that's a monthly rate. So if we multiply that by 12, we get 12.41%. So that's 12.41 annually compounded monthly. And that's assuming, again, that we hold this to maturity, because we're going to see, we could look at that by saying, what if we assumed that we would be getting rid of this loan in 5 years? Well, what we would do in this case, if you noticed here, I didn't write down the future value is 0, but we would put that in. But if we decided we were only going to hold this loan for, say, 5 years, we would find what would be the loan balance at the end of the 5th year and put that in for your future value, and then calculate what would be your effective cost. One thing about the APR, the annual percentage rate, is that it must be disclosed to lenders, just as we did right here. It would include all these costs, but it's rounded to the nearest 1/8. Okay, and they would assume also that you hold to maturity. But the nearest 1/8 in this case is 12.37. So that would be what the bank would show. So let's look now, include what if there was a early repayment with the loan fee. Okay, so the first thing we need to do here is solve for the loan balance and then solve for the rate to pay off. Okay, so this is just a continuation of the problem we were doing, and it is continued on page 86 and 88 in your text. So we've got the payment. We know there's 3 points, but now we're saying, as I had mentioned, what if we pay it off in 5 years? So we have to find the balance of the loan. So the balance of the loan would be the present value of all the payments for the remaining 300 payments after the end of the 5th year. So we use that our payment is $617.17. The interest rate is 1, and N is 300, because now we only have 25 years left, so 12 times 25, because we've paid off 5 of our 30 years. And we have the present value, that was the amount that we're borrowing. We're solving. The future value is 0, and we're solving, in this case, for the present value. And that's going to give us the value of the loan. That's $58,598.16. Okay, so again, the assumption in this case still is that the future value is 0. Now, step 2 is the present value, which should be a negative there, is 58,200, and put that in your calculator as negative, because that's the 60,000 minus the 3 points. And we put in our payment, $617.17, and now we use the future value, which would be the loan payment, the loan principal at the end of the 5th year, which we calculated in step 1, $58,598.16. Now that's a positive number. So the present value goes in as negative, but the payment and the future value as positives. Now in this case, the length of time, N, is 5 years, or 60 payments. And then we compute I. Then again, that's the monthly rate. So we multiply that times 12, and we see that the effective rate is 12.82. So although the bank is saying it's a 12% loan, compounded monthly, we see because of the points that they're going to show the effective yield at 12 and 12.375. But if we honestly assume that we are going to only stay there for 5 years, the real effective cost to us is 12.82. Right, so almost a whole percentage point higher. Okay. On page 89, you'll see that they give some of these relationships between mortgage yields and fees, and you'll see that the fee goes in those first 5 years. You'll see the one we just calculated, 12.82, and if it's even sooner, say you do it after 1 year, then your effective yield is 15.26. Okay, so if you end up only staying for a year, it really is very costly. But then as it starts to go down, it winds down. So what are some observations we can make about loan fees and early repayment? Well, if there's no financing charges, then the effective cost on the mortgage is equal to the contract cost. So if there was no costs, no points, no closing costs, and we held it for the whole 30 years, the effective cost is the contract cost. If there are finance charges, then the effective yield will be higher than the contract rate, and the yield will increase as the repayment occurs sooner in the life of the loan. Okay, so you should really be able to remember those two. Now let's add in the cost of prepayment. Okay, some states do prohibit after a certain amount of time, and some lenders waive if you will originate a new loan with them. So there might be some ways out of this, but let's concentrate on calculating the cost of this. So we'll kind of continue with the same problem, except now they'll add in that not only do you have the 3% points or loan discount, but you also have a 3% prepayment penalty. So let's say, same case, we're going to pay off in 5 years, but now we have to pay an extra 3% of the balance of that loan. So remember, we've calculated, based on the 12%, we've calculated a payment, $617.17. Then we calculated what the balance of the loan would be at the end of the 5th year, the $58,598.16. But now we say when we pay that, we'd have to pay an extra 3% because there is a prepayment penalty. So we would actually have to pay a balance of $60,365.10. So now we use all of those numbers put together and come up with what our effective cost is. So the present value is a negative $58,200. Okay, that was the 60,000 we need to borrow minus the 3 points. Then the future value is 60,356.10. That's the loan balance at the end of 5 years plus the 3% prepayment penalty. N is 60, because it just said we're holding this for the 5 years. We calculated, again, the payment rate with the 12%, and that came out 617.17. And we compute the interest rate, again, a monthly, so we multiply it times 12, and now we see it goes up to 13.25. So again, the bank would say it's 12% compounded monthly. They would have an APR that's disclosed at 12.375, but we would actually end up paying, if we paid this loan off at the end of the 5th year, our cost would actually be 13.25. Okay, so APRs do not include prepayment penalties ever. They just assume that you would not do it. So the APRs will include closing costs and points, but they will not, and they will assume that you go hold the mortgage to maturity. So they don't take into account that you may pay off early, and they don't take into account prepayment penalties. Banks could use this to price a loan to achieve a certain rate. So if a bank wants to advertise that it's 12% compounded monthly, but they actually want a 13% return, they could then figure out what kind of closing costs they need to come up with so that they have a 13% return. So if a bank wants to do that, so they want 13%, and they have the current going is 12% compounded monthly, and they believe that on average loans are paid off in 10 years, so they want to make that assumption too, then they could solve for what the balance would be. So first thing they do is say, again, this is a $60,000 loan, so they'd say, well, what would the balance be at the end of 10 years? Okay, so at the end of 10 years, you would have 20 payments, 20 years left. So 20 times 12 is 240. So that would be your N, 1% interest rate, and the future value is 0, and your payments, that $60,000 loan, is $617.17. So we get a present value of $56,051. Okay, so that would be the amount they would assume would be paid off at the end of the 10 years. So we know that's now when we're looking for the rate to charge, we say that would be the future value. The payment is the $617.17. The interest rate now, though, we want a 13% return. So we take the 13 divided by 12, works 1.0833, and we use that in our calculator. N is 120, because we're holding this for 10 years. So 12 times 10. And then we solve for what would the present value be here. And the present value comes up $56,717.45. So that would say that we'd have to have closing costs of the difference between that and 60,000, $3,282.55, which is 5.5% of fees. So the bank would have to come up between points and other closing costs, $3,282.55, and then they would, and under the assumption that the loan would be paid off in 10 years, they would get their 13% return. There are a couple of other loan patterns we want to look at that are not fully amortizing. One is a partially amortizing constant payment loan, or commonly referred to as a balloon loan. And these are on page 92 as an example here. But in this case, the real key is that you wouldn't be aiming to pay off. That's what the balloon idea is. There's some large amount at the end that you'd have to pay. So it may be only as short as a 5-year that you have to pay it off. So they may say, well, let's figure out the payment as they do in this manner, but you have to pay it off in 5 years. But generally what they're trying to do is get you to have a lower payment. So often these are done with second mortgages. But say you had the difference here is you'd have a $60,000 loan, but the thing is here at the end, instead of your future value being 0, it would be $40,000. So really over the 30 years here, you'd only be paying off $20,000 of it, and all of a sudden you'd have to pay off the rest of the 40 at the end. Okay, so the future value would be the $40,000, the interest rate's 1%, N is $360, and the present value is the amount you want to borrow, the $60,000, and you just compute the payment. One interesting thing to note here is that, instead of paying the entire thing off, you're only paying 1/3 of it off, but your payment is only going down $12 a month. Okay, so not much of a savings. We've heard a lot recently about zero amortization, or more commonly, interest-only loans. So in this case, all you do is pay the interest on the loan. So if you did have a fixed amount of the 12% monthly, we keep using 12 because it's easy. You divide by 12, so it's 1% a month. So you have a $60,000 loan, 1% of that is $600. So every month you'd pay the $600, but at the end of the term, you'd still owe $60,000. You would not have paid any of the loan off. And more recently, what we've actually haven't called these, they haven't advertised them as increasing loan balance or negative amortization loans, but they have loans that are offered at a lower rate than the going rate, or give you options, the option ARM mortgage. And one of the options is to pay an interest rate below the going rate. So you're actually paying not even interest only, you're paying less than that. So not only is your loan staying even, but it's actually getting bigger. Of course, they're not advertised this way, but this is what happens. So in this case, one way to illustrate it is just make the assumption that you borrow $60,000, but you agree to pay back $80,000 at maturity. So you're saying not only I'll borrow the $60,000, but I'll pay back more in the end. And if you use the interest rate of 12% compounded monthly for 30 years, we would put these in our calculator, and we would come out with a payment of $594.28. So again, not a huge amount down, figuring that you wouldn't have paid any of your loan off at all, and in fact owe more. This other one we really just threw in to kind of show, there's like any kind of structure you can come up with that we could think of. If you could sell it, you can get people to make it popular, you could like it. And for example, they have the amortization schedule or the callable loan. Here, you'd set this up and say the two parties agree the mortgage could be called at the lender's option at the end of some time prior to maturity. So kind of like a bond could be called away. Here, the bank could call it away from you. And in this case, it would be, say interest rates had gone up a lot and the bank has a fixed rate interest, they fix it at 6%, and now interest rates are 7, 8, 9%. They may call it away from you so that they can reinvest that money at a higher rate, but now you're stuck and you have to go out and find a new mortgage at a higher rate. So more than likely, for a borrower to agree to this, they would have to get a lower rate than the going market rate. But anything could be structured. I just quickly want to touch on this inflation and the mortgage problem. If you look on page 95, it's kind of an illustration of this tilting effect. And what they're saying is basically, kind of if you look at that very top line, that's the it says NP on exhibit 49. That's the constant nominal payment. But what they're trying to show you here is, that's the constant nominal payment all the way across. But if you take that constant nominal payment and you discount it back at whatever the inflation rate is, I believe they used 3 or 4% in this problem, you see that over time, that obviously real rate of the money, once you've deflated it, is much, the real amount of that money is worth much less. So even 10 years out, that $525 and some odd cents is really only worth a little under $300. Okay, so it's this idea that they have to collect more money from people up front because of this idea of purchasing power and inflation. This gives us some numbers to kind of show you. If you had income that was increasing at the rate of inflation, and you had your payments, but then now we're showing that if we deflated those payments, so your income's increasing, but what the value of that payment really is in purchasing dollars is going down, we'd see that when you'd start like in year one, your payment really be like 26% of your income. A year out, 24%. By the time you get 5 years out, it's only 18% of your income. So again, you kind of hit with this burden earlier on, and it becomes less, which, again, is something that's unfortunate in the way that the mortgages go, because it really should almost be the opposite direction, because as you make more money, you could handle a higher percentage, but that ends up being why people sell their house and buy. Okay, if you just quickly look at Exhibit 410 on page 97, it just shows you as the rate of inflation increases, so does the tilt effect. So this tilt effect basically has the effect of making it harder or more difficult for borrowers to qualify for loans. And the higher the rate of inflation, the bigger the effect. So one of the reasons we discuss this is because one of the ways that have come about to deal with this problem has been graduated payment mortgages. I haven't seen a lot of them recently, but let's look at how they be structured. Things can come back. The graduated payment mortgage, or the GPM, the idea here, if you look on page 97 and 98, actually 98 gives you the best picture of the graduated payment mortgage, really. Just to look at it graphically on page 99 there, Exhibit 412, because you'll see, if you look, it looks like little steps on the way up. You'll see you'll start at a lower amount, and it makes steps on the way up, so it eventually at some point, 5 to 10 years out, flattens out. And what you'll see is that it can start out lower than the constant payment mortgage, and eventually it will end up a little bit higher than the constant payment mortgage. But again, in real dollars, in purchasing dollars at that point with inflation, it is not as much of a burden if people's income keeps growing and going up. The actual dollar amounts, if you look on page 98, Exhibit 411, look under the 12%, so you've been looking at 12% all the way through, you'll see that it starts with a graduated payment of $474.83, okay, versus what would have been the constant payment of the $617. So you can get a lot larger mortgage with a payment of qualifying with a certain income for $474 than 617. But then you'll see it goes up by, in this case, 7.5% annually till you get to the point of the 6th year. At that point, it goes to $681, which is about almost $60 higher than the constant payment, and it stays at $681 for the rest of the 25 years. Okay. So going back to Exhibit 412 on page 99, at this point it gives you all of the types that we've looked at. The CAM, okay, so where we paid constant amortization, but the payment, we constantly amortized the loan away, but the payment went down because our interest went down. Then the constant payment, which is a flat line across, and then the graduated payment, where it goes up, starts at a lower rate than any of them, it goes up until it gets a little bit above the constant payment and then stays level. The advantages of the graduated payment are that the initial payment's lower, so it's easier to qualify. The disadvantage of this is that there is negative amortization, which means the loan balance increases during the first few years. So the loan balance actually becomes higher than the original amount you borrowed. And you see that in Exhibit 413 and 14 on page 100. You look at that example, look at the ending balance there, and you'll see that it actually goes up to 61, 62. At 5 years out, it goes to it's up at its peak, 64,722, and then it starts to go back down. But and eventually it still will, after 30 years, be zero. But you actually do have an increase. So if your property, if you needed to sell the property in those first 6-7 years, and the property went down in value, you may end up owing more money because your loan went up instead of down. So in that respect, it is a riskier loan for banks and for individuals. So you might ask, is the borrower better off with the graduated or the constant? If the fees and the interest rate were exactly the same, then they would be better off with the graduated, because the graduated reduces that tilt effect, lets them borrow more. But generally, because the graduated mortgages are more risky because of the negative amortization, that's why they're considered more risky, then anything with more risk is going to require a higher return. So in most cases, it'd be a higher interest rate or some kind of higher costs or prepayments, something in there to offset those positive features. So you'd have to look at the two of them and put it into perspective of how long you were going to stay in the mortgage and come up with what was the best fit for you. But you couldn't just say across the board unless everything was equal, interest rates, fees, and so forth. The last one I want to look at quickly is the reverse mortgage, or the RAM. This has been talked about a lot and is being used for people in retirement. So say you've paid off your house and your property value is $500,000, and usually they'll loan you about 50%. So in this case, half of that would be $250,000. And so you might decide, well, I'd like to get that paid to me monthly for the next 10 years. Let's say the going rate is 10%. So you'd have the future value, because that's what the loan will then be after the 10 years, the future value of the loan, $250,000. The agreed upon rate would have been 10%, but you're doing monthly, you're going to get monthly payments from the bank. So you do 10 divided by 12, n equals 120. The present value, you're not starting out with anything, you're only going to get the payments, is zero, so, and you compute your payments. So doing this, you could get $1,220.44 every month for 10 years. So you could get this payment, so basically sometimes I've heard people say referring eating your house or so forth, but get that back. And then at the end of that time, you would have to pay back the loan. Now you could either take a mortgage back out, then you'd have to pay the mortgage off, and more than likely if you were taking money out before, you wouldn't have that money. Or at that point, you might be ready to downsize to a smaller house, so you might sell the property. Maybe even the property's gone up in value. So sell the property and refinance with a new RAM.